Good morning, America. Hubert Johnson here with Taxes Made Easy. Just excited about today's show. We're going to focus on what happens if you have a high dollar case with a lot owed. So again, there are different ways to handle it, and it's very important to make sure that you're on track. I've had a few cases lately, questions here, so it's so important to get ahead of things and make sure that your financial house is in order, especially with your business. You guys talked about rocking it with the IRS, um, and making sure that you can thrive, not just get by with your business. So that's really our goal, is to help people prepare for and achieve long-term success when dealing with their tax situation. So stay tuned. We've got a lot of good news, and really going to dive into these larger cases and how to best address them. Welcome back, everybody. Thank you for watching Taxes Made Easy, either live or on rebroadcast. And again, if you have any questions, you can always reach out to us. Our direct number is 520-485-7371. And you can find us on the smartmoneyculture.tv or the smc.tv. So first, we want to touch on some articles here. And there's a general trend, and it hit both parties when it comes to taxes, when it comes to trying to make things better for society. It's either a tax and spend ideology, and Republicans can be just as guilty of this as well, where to implement government programs, to feel like they're doing something, they feel like they have to take more from the public. So tax, and then spend on their priorities, what they want to do, what their ideas are. So most ideas to do stuff requires money, and so you get this idea of tax and spend. It's really hard to go the other way. It takes more political courage to trim programs, because you're annoying the special interests that have been loud enough to get those funds. And there's sometimes, though, that people go in and they trim things too much. So famously, Ronald Reagan, when he was governor of California, came in and he hacked and slashed the budgets for mentally ill, for those that actually needed state care. And I've heard Republicans and Democrats alike criticize him for that. And because ever since then, they don't have a good voice. There's not a lot of big lobbies pushing for to take care of the mentally ill in society. Unfortunately, a lot of people are on the streets, and it kind of makes a bigger issue with the drug issue, and it leads to a lot of societal ills. So there's a balance to be had. Where is that? It's usually somewhere in the middle. Where common sense lies in finding that. This is a trick. So first article I'm going to share is about one of these things. Is this common sense or no? And this has to do with gas furnaces. So the Biden administration has been threatening, or actually passing regulations to limit or reduce, not only they've targeted gas stoves, that fell apart, but now they're going after gas furnaces. So they've already passed this law. Ted Cruz has scheduled a bill to overturn this executive action. So it's just executive action that people can only buy furnaces that convert at least 95% of fuel into heat. So fuel pumps, etc. This is new technology, and it's more expensive. But the idea is, by forcing people to buy things that are more energy efficient, they're estimating that they will save $500 over the new furnace's lifetime. So one, buying a new furnace or having to buy a newer furnace that's more expensive, and then over 15 years, you save $500, and that's based on their numbers. That's not a great deal. You have to figure in inflation. $500 over 15 years is not that much. If you give it 10 years, that's $50 in savings with the over a much higher upfront cost. And that's the thing when you're making homes more expensive, you're making it more expensive to put furnaces in every single new home. It just drives up overall costs. So does this make sense? Part of it is that they want Americans in general to reduce their use of energy. There's a lot of demands on the electric grid. We have more people, and we have not been investing in our electric grid and electric production. We've been cutting it back, if anything. And so this is one way to tackle this, is by forcing people to buy more efficient but more costly furnaces and products. My concern with this is when they're claiming, hey, $500 over the lifetime of a furnace that can cost, I don't know, 10, 12,000, isn't a lot of savings. And as energy prices go up, those savings these are estimated earnings based on future projections over the next 10, 12 years. These numbers might turn out to be accurate. They might turn out to be total bunkus or garbage. Kind of like the new electric lights that are much more expensive than the previous lights, and the light bulbs. Well, they got rid of the incandescent light bulbs that created heat. So now a light bulb costs $4 or $5 instead of 50 cents or to $1. This just makes, again, they're forcing people to spend a lot more money, and these lights tend to go out just as quickly, in my opinion. Depends on where you're buying them, but overall, I'm not seeing a benefit. Now, we talked yesterday about Massachusetts, and I try to share both sides of the story, opinions from both sides. And they had this billionaire tax, and they were so happy about, they were touting the success of this bill, and the critics were saying, well, even though you're getting more money in the short term, watch out as to what happens long term. Now, this is from Bloomberg News, from Yahoo Finance, so this is not a conservative site by any means. And Bloomberg's coming out and saying they could lose $1 billion. What's happening in Massachusetts? The working class people, up and coming workers, can't afford to live there. Even though they're making good money, by 2030, they're making $1.6 billion now, and they're saying in 5 to 6 years they'll be losing $1 billion per year because more and more people are going to flee, and they're already seeing that. The last year, they're estimating 96,000 residents will flee based on current statistics, and they make a combined $19.2 billion, which would be $961 million in tax revenue not lost yearly. So just last year, they lost 39,000 residents, mainly to Florida and New Hampshire, which is right next to them. One of the reasons for this is that you have, among people entering the workforce, 26 to 34, and more than half are high earners. So these are people coming out of college, coming out of, they have high degrees that can demand a lot of earning power, and they're leaving the state. So again, it's the return to office rate is another factor here. It's 39% below 2019 levels, where like New York's office rate now exceeds 80%. So again, these statistics can be a little bit misleading just looking at them. 39% low would be 61% return rate versus 80%. But because you still have fewer people returning to the office in Boston, If you're working remotely, it's that much easier to just go somewhere else, especially to avoid higher taxes. So Maine, New Hampshire, Florida, North Carolina, Texas, mainly places that have lower taxes, cheaper, and more affordable housing. Because in Massachusetts, things are not cheap and less expensive healthcare. So this is a 4% surcharges on incomes of more than $1 million. Like I said, the first 9 months is created 1.8. That's what they were celebrating. But it's short run, short-sighted thinking. We might get more tax revenue. And if that's increasing out migration, people leaving the state, it's probably going to cost them more money in the end. So again, looking for, hey, let's just tax the rich, usually backfires. And usually helps the people that they're trying to provide funds for. So again, you can only squeeze people so much before they say, cry uncle, and leave somewhere else. And we're having a huge migration from blue states, especially in the New England and California areas, fleeing to areas that are more that have better taxation policies or lower taxation policies. Now, even though high taxes are a huge problem, another problem hitting especially the elderly, Social Security payments are going to increase by a whopping 2.66% in 2025, according to the Seniors League. 2.66% is not keeping pace with inflation. So this is based on the official federal numbers that we know are really low. Housing utilities, housing costs have gone up about 11% alone, and a 2.66 COLA increase or cost of living increase doesn't really help. It helps address some inflation, but because the government numbers are skewed, these people are really going to get hurt. So even based on the government's numbers, inflation so far for last year has been 3.4%. So they're losing money right now, but when you look at real inflation, not the government numbers, it's much higher than that. And so I see all kinds of elderly people struggling like crazy to get by. And there's 66 million people relying on Social Security. Now, to be fair, a lot of people have other sources of income. They're not just relying on Social Security. If you just be aware of how these issues, how it can affect people up and down the political spectrum, but also individuals here. So we're going to touch on a couple more things and then dive into our main topic. And we'll be back right after this break. Welcome back, everybody. Thank you for watching Taxes Made Easy. We got one last article that we're going to share and talk about before we dive into the main topic for today. And this really goes into understanding both sides of the case. So if you're not familiar with where Paul Krugman is coming from, where John Maynard Keynes is coming from, you should read up on it. On the flip side, you should understand where Milton Friedman is coming from in that line of thinking. So this is an article making fun of Nikole Hannah Jones, but at the same time, and comparing her to Paul Krugman. Paul Krugman is a well-known leftist economist who claimed inflation had already been conquered, and that was a year or two ago, and then had to walk back his words. He's pretty much been a cheerleader for the Biden administration and argued for continued spending. So spend into oblivion. It won't hurt the economy, won't drive inflation, and that's exactly what it's doing. So she very well known Nikole Hannah Jones. She is a professor at Howard University, a New York Times columnist. She received a Genius Grant from the MacArthur Foundation, um, an award-winning investigative reporter, and she also founded the 1619 Project. Agree with it or not, it's had a huge impact on our schools. And again, she's had many awards. So she posts this question. This is where all of this is coming from. Ida Bell Wales at Hannah Jones. Hannah Jones is her Twitter handle. And she posts, most wealth is not used to create jobs. Most wealth is stored away and used to create more wealth for the wealthy family. So, first response is, if by stored away you mean invested, then yes. Most wealthy people invest their money, turn into more money. Investment often creates jobs and opportunities. I mean, it has to, but even investment, you're buying things, you're putting your money to work. So it really comes down to, it really addresses, and she responds how. So either she's clueless or she's not understanding how money actually works. Talk to Warren Buffett, he's got billions of dollars. He's a billionaire. Is his money sitting in his bank, in piles of gold or in stacks of cash? No, of course not. Because what happens when you take money and you just hold on to it? It loses value. Year after year, due to inflation, it just loses money over time, or it loses value over time. So if you just hold on to money, and they take this and respond a little tongue-in-cheek here, it does kind of explain it, that there was a time during feudalism where wealth mainly came through conquest and grabbing property and goods and gold. And a classic example of this is with the Spain in the New World. They went and they looted. Sorry to the Spanish, but yeah, they essentially looted the Aztec and then empires, stripped it of gold, and sent all that gold back to Spain. Now, you would think that Spain would have been the richest, most powerful country, and for a while they were. But what happened when they flooded the European markets with all this gold from the Americas? It helped out in the short term, but very quickly the market was saturated with gold. So the Spain and their gold coins and everything very quickly had massive inflation. It caused a lot of problems for the Spanish economy. And within 100 years, they went from superpower to has-been. It didn't help in the long run, which is, there were some things done with it, but most of the money went to corruption. A lot of it went to enforcing, very burdensome and expensive wars throughout Europe. It didn't take long for Spain to lose, going from the Spanish Armada threatening to invade England to 100 years later, Spain was again relegated to a second-rate empire, or second-rate kingdom. Now, that's simplifying things a little bit. But again, buying power, if you look at from 1913 to 2020, we all know inflation is slowly driven and eaten away at the buying power. So that's $1 million. Not the same. Actually, that's $1 million. Not the same as it was back in 1913. So if you take your money and just stick it in a bank, or you just hold on to items like gold or whatever, they tend to lose value over time. Now, gold as a commodity is a little different, but almost exclusively in capitalist societies, wealth is created through invention, innovation, and increased productivity. Building and doing things that others are willing to pay for. That's capitalism. So it doesn't just grow. You can't put it in a mattress. You can't put it in a bank and just expect it to grow. You have to invest it. And investment and savings, honestly, is we talked about this the other day. We don't encourage saving in our country. We discourage it way too often. We want that consumerism, buy, 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 buy. However, people invest, that creates assets that people can then borrow. You put it in a bank. The bank doesn't just leave the money there. They turn around and invest it. That's how banks make money. And if you're most of the wealthy, what they're doing is they're investing that money to create and drive wealth creation. So again, the idea that, and this is one of the quotes from Milton Friedman I shared a couple of weeks ago, the idea, one of the biggest, worst ideas out there is that there's a fixed pie. And that if you take a piece, more of one piece, you're taking it from someone else. However, the value, the economic output is a pie that can grow or shrink. So if you help others grow their piece of the pie, many times that helps other people because then they're spending more money, they're investing throughout the economy, they're creating jobs, and it helps people, it helps the economy all around. So people don't just sit on wealth, they use it to create stuff. So you look at some of the wealthiest people out there, unless the money was inherited or they're not sitting on these funds, they're doing something with it. So, and is it bad to be wealthy? Absolutely not. It's what you do with it. There are plenty of people that do amazing things. Someone that's not my favorite actor, Vin Diesel. I'm just not a fan of his movies. Not my cup of tea. I tried to give him a chance the other day because I read an article that said, hey, he was a Eagle Scout and he would donate, had a yearly donation of $1 million a year to Boy Scouts, and I was like, well, that's pretty cool. And so I tried to watch one of his movies. I couldn't watch it. Just not my cup of tea. But he is doing good things and taking his wealth and really helping an organization. It's changed, and so the article is really about how he was stopping his donation to Boy Scouts of America. Now that's Scouting of America, but he's donated millions and millions to a charity dedicated to help the youth of our country. That's commendable. Whether or not you agree with him stopping the donations or not, but the fact that he donated millions, every single year donated $1 million quietly, nobody's noticed or knew anything about it. That I think reflects on his character, and that should be commended and encouraged in our society. So I want to really focus on some high dollar cases. When I say high dollar, doesn't mean they're rich. This means they owe a lot of money. So, number one problem I see in high dollar cases is that they make the same mistakes that someone with a small business can make, or someone that is, living on the margins can make. People are human. You would think that once you're dealing with hundreds of thousands into $1 million, that everything, they have a team of attorneys and CPAs there, but unfortunately, many times it's exact same mistakes, exact same problems getting repeated over and over again. And so it is so important to get good advice. Check around. I can't emphasize this enough. So, first case I want to talk about is this gentleman. He owes around $800,000. He doesn't have $800,000. This is an example of someone that owes a lot but doesn't have hardly anything. And the money that he had and that his family had was frittered away on attorneys that gave him horrible advice and put him in a much worse situation than he ever needed to be in. Now, part of it, he probably didn't listen very well. So if you have someone that tells you what you want to hear rather than being straight and honest with you, run for the hills. If you're hiring and you're paying someone a lot of money and you're not going to listen to him, what's the point? So the key issue in his case is that he had a house paid for. Now he has a lifetime disability that's getting worse, and as he's now retirement age, can't work and hasn't been able to work, has worked odd jobs here and there, but hasn't really been able to have a career due to a severe disability. So a very sympathetic case. However, racking up $800,000 in liability happened over time, and the history of the case that he listened to other people that told him, "Well, do this, do that, let's fight it in tax court," which again is very expensive. If you have someone that just says, "Hey, let's go to tax court," get a second opinion. Run the other way. Now, there are times, yesterday, I was dealing with an intense audit where I said, look, we're probably going to have to go to tax court on this. But it's a novel issue that probably, we're going to be doing research on it to see if it's been litigated yet. But this is dealing with international treaties, immigration law, as well as tax law. So this is a very complex issue, not something you're going to run across every day. And the IRS is taking a novel approach to this and trying to push policies that are new to the great detriment of our client that would actually shut down a multi-million-dollar business and put hundreds of people out of work. Way to go, IRS. That's something that you might consider going to tax law for, where you don't agree with the IRS's interpretation of the law, you think they're wrong, and it's just their interpretation. So you can fight it, and the best way to fight that is you can go through appeals, but if it's not decided law, they can say, well, this is what I think it is. That's where you need to take it to a judge and argue it through a judge. Now, like I said, most cases that I've seen go to tax court, it doesn't make sense at all to be there. And ironically, prior to the Biden administration, he could have done an offer and compromise, just shown that he can't access the equity in his home, which he couldn't. He couldn't take a ton of money out of his home. And he could have done an offer and compromise and wiped it all out. Prime offer and compromise candidate. Instead, these other attorneys, they instead of offering an alternative that's cheaper and more effective, they pushed him to go to tax court, or he wanted to go to tax court, and they didn't talk him out of it. So what happened in his case? He went to tax court, and he's arguing every little thing here instead of just dealing with them and using the IRS rules and regulations for his benefit. So he went to tax court and lost. Then he decided to go to district court and continue fighting and lost. And then appealed all the way up to the Ninth Circuit Court of Appeals, and that's where I stepped into the case. And we're fighting tooth and nail just to save his home. We're very close to doing so, but again, if you're going to tax court, then district court, you either need to have a very strong argument on a novel issue, or you're wasting everybody's time. What are you doing? And unfortunately, too many attorneys are raking in the dough when they're taking these kinds of cases. So be very, very careful when someone mentions tax court, district court, let's just file for tax court. Sometimes you do it to preserve rights by filing a petition. But explore all of your options. If someone's not laying out all of your options for you, go get a second opinion. Pardon me, I have a little cough going. So in the end, we're trying to save his house and give him a life estate in it, but the value of the house is eventually going to go to the government. Whereas if he would have dealt with it directly with the IRS, different issue altogether. Second case study. So this is this other case that I was talking about. Huge novel issue. But this probably wouldn't have even come up. I'm pretty sure it would not have even come up if the taxpayer had his books in order. We really talked yesterday about making sure you have good bookkeeping, that you're talking to a corporate attorney, and this is a multi-million-dollar case or a company, and they're not doing it the right way. They had an accountant, typical story, the accountant passed away, they got a new one, the new one didn't know what he was doing. So this is what, and now they're in a multi-year audit. They have all kinds of problems and issues, and the IRS is coming after them in multiple ways. And there's areas that they definitely messed up, that they're definitely going to owe taxes on. But the IRS is going even deeper in ways that could shut down the entire business. This is absolutely when you need a tax attorney, make sure you get in there and do it right. So what I talk about, when you hire tax professionals, don't hire and forget about it. Hire them, listen to their advice, and then follow up with them. Make sure they're doing what you hired them for. Tax professionals, bookkeepers, even CPAs make mistakes. They get busy. Stuff happens all the time. And again, it can become a real mess when you don't have your financial house in order, your record keeping, all of that. It pays and will save you so much money and heartache to have things put together. It will save you in making estimate tax payments correctly. Again, now they're getting charged 8% interest throughout the tax year if you don't pay sufficient estimated tax payments. And I don't know how you run a business for over a year and you don't know what your finances are, what your numbers look like. If you look at all the top corporations, there's a reason they do quarterly reports, quarterly numbers. They're required to share all this information with their shareholders. But they have all this information. They're looking, their owners, the managers are looking at these numbers every month, if not more often, so they can see exactly what's happening and make changes and adjustments to improve their business. As a small business owner, you should be doing the same, and there's no reason you can't with the tools that are at disposal today. QuickBooks, Intuit, bookkeepers, if you're a bookkeeper that's really on top of it, you should have at least a quarterly P&L. So one, you can make sufficient estimated tax payments, but two, you can look and see how is your business doing? What is the health of your business month after month, or at least every quarter? So when we come back, we're going to talk about some other stories and how to protect yourself as a larger company. So we'll be right back. Welcome back, everybody. And I just want to focus on some things here. It's hard to find good tax professionals, and it's even harder to find good tax professionals that can truly tackle difficult tax issues. The more complicated your case gets, the larger the company is. There are plenty of people that will try, but there's few people that truly have that experience. So again, this is for a case that I had years ago. And this again was a multi-million-dollar company, over 500 employees. And they got hit because their CPAs didn't understand the new Obamacare rules and regulations. Most people didn't. And so they thought they were doing it right. They were going through the motions. And then, lo and behold, the interpretation changed with the Biden administration. And so they argued that, no, the law needs to be this way. You should have done more to provide health insurance for your employees. And they got hit by huge penalties in the millions of dollars. This threatened the whole business. And they had state issues that they had to deal with as well. So they need someone to go in, deal with the state, deal with the IRS on this very narrow issue, get it figured out, and get their business licenses back in order, because this was threatening their very business. They had called, they had dealt with other CPAs, other professionals, and most people are like, we don't know. And to be honest, I hadn't dealt with this particular issue because it was a very narrow issue. But we got in there, got involved, negotiated directly with the IRS, dealing with the state at the same time, and got it taken care of. And now her business is still running, operating, and they have their business license back. Everything's been put together. And they avoided a lot of the pain going through collections. But you have to find someone that's flexible, willing to do the research, willing to do something outside the box. And really, when you're researching a new topic like this, or you have a novel issue, you really do need to be talking to an experienced tax attorney. There's plenty of times I tell people, look, you don't need someone like me. Small enough case, you can fix it a lot more affordably than hiring a tax attorney. But if you owe hundreds of thousands of dollars, if you owe in the millions of dollars, you really should be talking to a tax attorney. You should be talking about to someone that has a lot of knowledge and experience. And if you're not comfortable with what they're doing, or they don't feel like they're doing what they should be doing over time, get that second opinion. And whoever you hire, before you hire them, check them out. Check out their credentials, check them out online, their reviews, etc. It is so important that you find someone. And again, this large company that I assisted, they took years to find the right person, and even it took them years to find the right CPA firm to handle their payroll, not only their payroll, but also make sure that they were compliant with all the Obamacare or ACA reporting. Very, very tough for larger businesses, and a lot of them got hit with massive fees and penalties. And it's affected productivity. It's affected, every time the government is going into a business and taking massive amounts of money, that's that much less money that they have to be productive. That's money taken out of the local economy, and it hurts. It hurts. So as best you can, be prepared, and be prepared to tackle these tax issues early on. So when preparation and having good CPAs, having good tax preparers, and not people that just do everything for you, but they help explain it to you. That is key, is to have good explanations and to help you through the process, but that you come out of the process better informed, with a better handle on your finances, and that you understand exactly what needs to be done. Now, I've kind of hammered home about these estimated tax payments, doing quarterly profit and losses. So just the other day I was in a conference call with other attorneys, with CPA, they're trying to make sure we did right by a client and making sure that everybody was on the same page moving forward. And one of the big issues here, and I want to, for people that are self-employed or business owners, if you're taking, it's very typical in the past that people would just do a K1 at the end of the year. They would figure out what the profit was and then give a distribution out to all the owners, medical offices, other businesses, and then that would be your income for the year. So they would take a salary to meet most of their needs throughout the year, but then at the end of the year they would do a K1 and do one large distribution. The IRS wants to see those payments throughout the year. So if you get one big sum at the end of the year, that's typically how people owe money. So if you're not paying taxes throughout the year and then something happens, life happens, you get sick, all of a sudden you get this big chunk of money and it gets used for other purposes. If you don't set aside and pay those taxes every time you get money, then you're going to be in a world of hurt. So again, this case in particular, again, it's very typical. I've seen it in other cases. They were the taxpayer was paying on his W-2 income, having sufficient withholding out of his income, even increased it, but it wasn't enough because he was getting K-1 income on top of it throughout at the end of the year. But the IRS wants to see those estimated tax payments broken out throughout the year. So even if you're going to have this huge tax bill, the IRS wants you to pay the taxes on it throughout the year, even if you don't take the money out of your business. So you don't have to take it out, but you should be looking at your P&L at least quarterly, and every quarter make those estimated tax payments. So that it does two things. First of all, you avoid the 8% penalty that they're charging as of November of 2023. I'm trying to sound the alarm here because a lot of people are going to get hurt. And a lot of wealthier individuals, people that invest and build on our economy, they're going to get hurt by being surprised by this. They're going to do the same thing that they've always done because not enough people, there's not enough news out. It's been in the news, but unless someone talks about it and hammers home on it and continue to, I expect a lot of people are going to get hurt by this change. So you need to make quarterly payments. You need to make it to avoid the 8% penalty. It also helps you understand and know what your business is doing. So doing these quarterly payments will give people better information, but also requires that your CPAs know what you need. This is unusual. This is different. So if you have a business, you have a high income, you need to be talking to your CPA and saying, hey, I listened to this tax guy, and he said I need to do quarterly P&Ls and make quarterly estimated tax payments, which means I need the information every quarter. And he'll probably say, well, like the CPA I was talking to yesterday when I was talking about these, like, yeah, we got to jump on the ball more. We'll be more on top of it. We're getting more help. We'll be able to do that because it needs to be done. But many CPAs I've talked to haven't heard about this. They don't know. So I can send you the articles. Again, I've talked about this ad nauseum in my programs. IRS.gov. You can look it up at IRS.gov. And so it's important to know about this, to address this. And, again, if your CPA ever has any question, who's this crackpot on this, smartmoneyculture.tv telling me that I need to do more work? It's actually not more work. The numbers have to be compiled throughout the year anyway. And if you do it more frequently, it's less of a chore at the end of the year. And you can actually probably file your taxes a lot sooner rather than waiting until October or for corporate returns, September of the next year. And half the problem with that is if you don't do your P&L until September of the following year, 9 months have already passed before you get a profit and loss and you have an idea of what your business did for the previous year. So if people wait till September of 2024 to file their 1120s, file their partnership returns, their 1065s, and that's when they're getting a profit and loss statement and getting a good idea of what happened with their business, it's 9 months after the year ended. How useful is that information? Not nearly as useful as if you're looking at it quarterly. Quarterly, you're dealing with real-time numbers. This is what just happened. These are adjustments we need to make. When you're looking at 9 months after the year happened, you can make some adjustments, you can make some plans, but frequently the facts on the ground have changed. So, compare it to the fog of war, what's actually happening at the ground at the time. If you're 9 months behind and you only get this once a year and it's always 9 months old, you don't have good information on your business. So again, if I'm harping on this, it's because it's important. And because I'm encouraging CPAs and business owners to get more on top of their business, know what's happening with their business, and stay on top of these estimated tax payments. It can save your business. It can help you make better business decisions. And when you have that information at your fingertips, you can go talk to a business coach. They can help you with good information. With outdated old information, it's a lot less likely that they'll be able to help. You can go talk to a financial advisor and say, okay, well, how I have this extra funds, how should I invest it rather than losing value due to inflation? So you can invest money, but keep it available, at least a money market account, something, so you're not losing as much of the value of your money to inflation. There's plenty of businesses that have savings built up that are invested, so they're earning money on their money while they have this safety net or fallback amount that if in case they need it. That's wise and prudent planning for your business. If more businesses did that, they wouldn't fail. They would be a lot higher success rate. So, kind of running out of time today. There's so many things to talk about when it comes to larger businesses. Key thing here is don't wait. Do not wait till the IRS is banging on your door. Do not wait or play games with the IRS because you can get really bad advice. Someone says, hey, we'll just delay things and kick the can down the road. They might be doing this and then telling you everything's fine. If you don't understand exactly what the objective is and where you are in the process, and you can't sit there and talk to whoever's representing you and get that information, get a second opinion. I've seen way too many cases hosed or damaged seriously because people were playing games with the IRS. I've shared stories of the IRS was in the background sharpening their knives as they did frivolous appeal after frivolous appeal instead of working proactively to resolve a case. So again, that's how you find success. That's how you resolve cases. Doesn't matter how high the dollar amount is. If you get in there and the IRS can see that you're actively engaged and you're working towards a good resolution, they'll work with you. They have to work with you. If you've checked the boxes and you have a revenue officer or auditor that's being extreme and you're doing what you should, appeal it. Go over their head. Everybody has a manager. There's regional managers. There are plenty of ways that you could appeal it without destroying your case, without jumping to tax court prematurely and costing yourself $25,000 to $30,000 more dollars. So if you do have those questions, give us a call, 520-485-7371. Much rather see someone. Call us, get the right help before I'm referring somebody to a criminal defense attorney. And I've had to do that. I've had to refer people to white-collar defense attorneys for tax law. So I was glancing real quickly, getting an update on the story with Hunter Biden. And I help people that owe more money than Hunter Biden. Why is he in tax court? You could argue it's political, but it's mainly because he's hid stuff. All of this Burisma money, all of the funds he received, legally or illegally, he hid it. He did everything wrong, didn't come clean about it, and when you take actions to hide facts from the IRS, hide income from the IRS, and this is what's alleged, that's where you get in trouble, and that's where you have criminal charges pending. So again, I have bigger cases, don't even have to worry about tax court because we're doing it right, or don't even have to worry about tax court or criminal court because it's being handled correctly. Get that peace of mind that you and your business need so you can thrive and focus on doing what you do best. And again, I have plenty of success stories where we've helped people. One individual resolved $250,000. We were able to take that burden off of his shoulders. He was able to go to work and pay it off within a year or two, and then was doing just great. So this really helped him. That's our goal, to put you in a better situation, inform you, educate you and build a team around you so that you're taken care of moving forward and that you can sleep easy at night. So call us again for that peace of mind. Our website's guardiantaxlaw.com, and have a great day.